So after the March 12th liquidity crunch that obviously was driven by the COVID-19 concerns, we saw Bitcoin go and the wider crypto markets as well go on an absolute tear through the end of 2020 and into 2021. What do you see as driving this bull market? Is it just price manipulation, as some claim?
Well, we don't see much price manipulation out there. What we see, and this is all very public, and I've spoken about it previously in the past, is in the response to COVID-19 from governments around the world has been for fiscal easing, right? That governments have had to spend a lot of money protecting the economy, quite rightly, because you're talking about millions of people's jobs, lives at stake. So the state stepping in to provide support that's exactly what the state is there for, in my view. But to do that, they effectively have printed the money, and although no one has a problem, although it's the right thing to do, as an owner of assets, many asset owners, although they agree with it's the right thing to do, you still don't really like being on the end of debasement fundamentally. And so I think a lot of the traditional financial community, we're looking around at, okay, what does the landscape look like in this scenario where of huge easing, quantitative easing, monetary easing, what assets out there are immune or less exposed to this, and more people concluded that asset was Bitcoin. And very famously, very well known, people like Paul Tudor Jones, people like Stanley Druckenmiller have been very public that they have allocated to Bitcoin for precisely those reasons. And that was in a sort of May, June time. And then as we rolled through the year, as the price kept going up, and the price was driven by people like Stanley Druckenmiller, people like Paul Tudor Jones, firms then like Mass Mutual coming out and telling the world that basically it was them. They had gone out and bought a lot of Bitcoin. Mass Mutual famously said it had spent $100 million acquiring Bitcoin. Now, they were doing their acquisition of Bitcoin through August, September, where the price was about 10,000. So they now own about $400 million worth of Bitcoin. And yeah, through 2020, the latter half of 2020, almost every week, some well-known either financial or corporate player was revealing that it had acquired X amount of Bitcoin. And so it's quite easy, so it's pretty obvious who was driving the price. It was the actions of these firms, these institutions, these individuals. And that's where we are today, whereby more and more institutions are, giving some serious thought as to what they should do about their interaction with cryptocurrency. I term it as it's the broadband moment of cryptocurrency. This could very well be the broadband moment when, if we wind the clock back to roughly 2008, when broadband became widely available pretty much everywhere in the world, in the developed world, every CEO of every company all of a sudden had to have an internet strategy. They had to have a strategy on how they were going to deal with the internet, because they could no longer, it was no longer acceptable on an analyst conference call to say the internet's got nothing to do with me. That said CEOs could say they're going to sort of ignore it. They're not going to deal with the internet, but they needed reasons. They needed cogent reasons. Very famously, Walmart, in 2006-7, laid out their strategy, which is we're going to build ever larger stores, because that's the best way to grow our business, and it's not the internet, which was perfectly valid at the time. Walmart still grew at a very impressive pace. But for every Walmart, there were lots of instances of companies whose inability to answer that question saw new CEOs being appointed in pretty short order. And I think that certainly, at least for the financial institutions, the question of what is the firm's strategy for dealing with changes that cryptocurrencies will bring? How will it interact with cryptocurrencies? I think every CEO is going to need a pretty cogent answer to that question.
I think if we look at the past cycle of 2017, but also dating back to 2013, one of the institutional investment theses was, to put it succinctly, blockchain, not Bitcoin, right? That they were going to take this underlying technology and apply it to their existing use cases. Do you think that thesis has been successful? Have their investments in blockchain technology, without the currency element, has that delivered on the efficiencies that they were expecting during those cycles?
Yeah, that's I think some of us have forgotten about the blockchain, not Bitcoin thesis, and it's interesting you bring it up, yeah. But I think that it obviously varies between institution, but for the industry as a whole, I think right now the answer is no. Their investments in blockchain technology have not yielded any significant benefits, significant results. JP Morgan recently came out and said that its blockchain initiatives have proven to are now profitable, whatever that means. So some institutions clearly have had some success, but for the industry as a whole, I would say not yet. But that's not to say it won't come. I think that but yes, it's that sort of that slogan, if you like, that soundbite, blockchain, not Bitcoin, is probably, it's exactly the sort of thing that is being re-examined right now. That, okay, our view was blockchain, not Bitcoin. Does that view still hold? Given the evidence in front of us, is that still our approach, or does that need to be modified? I think you raise a very good point. That's almost exactly the question that is being asked in the boardrooms of all the major financial institutions. And yeah, we shall see what the answer is. But I do think that through 2021, we're going to hear from a lot more financial institutions publicly about what they are going to be doing in terms of interacting with the cryptocurrency space. It still could be no, but it's going to be accompanied with by 5 slides and some serious explaining as to why. It won't be a pure offhand dismissal.
Yeah, and one of the interesting parts about the blockchain, not Bitcoin thesis is that I would have expected that in 2020 we would have seen some of them shift to blockchain and Bitcoin, but the institutional Bitcoin folks that have come in, they did not have a history with blockchain. Someone like Paul Tudor Jones, I don't think we'd ever heard him talk about blockchain technology before that. And it was really like Bitcoin, not blockchain, in the sense that they were looking for the specific asset with those properties. So going forward, how do you see that evolving of what's next for the institutional investment thesis? What are the other opportunities if there is consensus solidifying around digital gold? What are other points of consensus that we could see emerge among institutions?
Yeah, it's I guess that that is the big question that's out there. What next? As you said, there's coalescence around the notion of Bitcoin as digital gold, Bitcoin being better at being gold than gold itself. So what next? And I think it is around, the other at least major coins out there. I think that, very interestingly, as you know, the CME has announced that it will launch an Ether dollar futures contract on February the 8th. That contract will actually settle to the Ether dollar reference rate provided by CF Benchmarks. So we're very excited to be a part of that with CME. But I think that that's where the debate will move on to, because now with the CME launching the Ether dollar futures contract, that gives institutions a bridge to participate in the price action of Ether. In the same way as 2017, the CME futures launch allowed institutions to participate in the price action of Bitcoin. So this contract launch will allow them to interact with Ether. And then the question will be, once the tool is there, the question will be why, right? So what is the investment thesis of Ether? And as you say, investment theses, different types of investment theses suit different types of investors. So it will be very interesting, who will we hear from around their thoughts of the investment thesis for Ether? Because it makes a lot of sense that people like Paul Tudor Jones, Stanley Druckenmiller are the ones who have talked about Bitcoin and are influential when it comes to thinking about Bitcoin, because they are macro traders. They made their names, made their money, taking views on their views on the relative value of the dollar versus the pound versus the euro, fixed income assets versus equity assets, etc. So it's very fitting that they thought long and hard about Bitcoin, and as you said, not about the blockchain part, because like you, I've never ever heard Paul Tudor Jones talk about anything more technologically advanced than email, quite frankly. But he tackled the investment thesis, the investment case. What is Bitcoin? What does it represent? So if we think about that for Ether, the very interesting thing is that I very much doubt that it will be Paul Tudor Jones or Stanley Druckenmiller, because Ether and the Ethereum blockchain is effectively a vision of how the future looks and how the future will work. And although Stanley Druckenmiller and Paul Tudor Jones have many, many talents, futurism isn't, as far as I know, one of them. So potentially we're looking more towards investors from Silicon Valley. Historically, at least in the past 30 years, the people whose job it is to bet on what the future looks like on behalf of the rest of us, on behalf of pension funds, on behalf of insurance companies, etc., on behalf of institutional capital, have been the big venture capital firms in Silicon Valley, the Sequoia Capitals of this world, the Kleiner Perkins, etc. So it therefore, should history repeat itself, or at least rhyme, the market is going to look to these sorts of investors, these types of actors, to give an investment thesis around Ether. I think that's my view, and that's where my ears are pressed to when it comes to the Ether futures launch, and what for want of a better term, the Silicon Valley technology investment community has to say about Ether. Because Ether, at least in my view, is, if you've got a thesis around Ether, it's because you think the future will look a certain way and operate in a certain way, with the Ethereum blockchain at the heart of it.
And from Silicon Valley's perspective, of seeing what the future is going to be like and then translating that into investments, traditionally that's been through equity ownership of private companies that are not public, right? Are illiquid. So is there a contradiction there for them, where Ether is liquid enough, too liquid for Silicon Valley, but not liquid enough for Paul Tudor Jones? and it's going to be retail driven for, as it has been, or do you think that there's a way to square that circle?
Yeah, it's fascinating. You know, obviously the Silicon Valley VC community has, there's a lot of factors have driven their returns, and as you rightly point out, the private market factor, the private market discount, effectively, that they have been willing to, which if you look at it from a risk parity perspective, you would say that it was a mispriced risk, that over the past 30 years, investors have applied far too big a discount to private illiquid companies than is reasonable. And Silicon Valley's returns, a lot of Silicon Valley returns can be explained by this illiquidity private discount that they have taken on and then enjoyed the removal of when they exit these companies. I'm sure that their returns have partly been that, but also I do think that, to be fair to them, probably there's a little bit more to it than that. And even if you take away the liquidity discount, the private discount that applies there, I think you would still see actual alpha, because they're not the only actors in the private space, in the, if you like, trying to producing returns that contain the liquidity discount and the private discount. The same is true of venture investors away from the technology space, but the returns there just don't compare. Here in Europe, one of the first big venture capital firms was a listed firm here in London, 3i, which was a VC firm not focused on technology. There are many VC firms not focused on technology who still invest in relatively small private companies, et cetera, but they have not generated the sorts of returns that Silicon Valley has, the technology-focused VCs have. So I think that, the fact that it's traded and is available to all and is relatively liquid, I don't necessarily think that will either dampen their enthusiasm or remove part of their reason for holding it.
Got it. And we've seen VCs also try to finance Ethereum challengers, right? And they seem to be struggling because of the network effects of these protocols to actually make inroads there. Do you think VCs are going to continue down that path, that they don't yet see Ethereum as the clear winner for the decentralized world computer thesis, or are they going to eventually capitulate and really join consensus, join Ethereum Foundation in investing into the Ethereum ecosystem and ethers as well at CME?
I think that, that's again, that's probably the $63,000 question, isn't it? I think that there'll probably be a variety of approaches, and I think it also depends on that specific VC downstream application investment strategy. So if in your portfolio you've got a number of applications, number of firms that are building applications, building apps that are underlying blockchain agnostic, and they could interact with lots of different chains, then your infrastructure bet, if you like, which chain are you gonna invest in, becomes less important, right? Because your real bet is on the applications in the portfolio that you've got. But if your applications are all dependent on a specific chain, then your eggs are in that basket, and you're going to push you're going to keep pushing that underlying chain. So I think it really depends. I mean, as we, I'm certainly no expert in this area. I'm really going by what I see on Crunchbase, where capital has been deployed. But I think that at least the ones I've seen, there is a mixture. There are some firms who have some VCs who have a lot of application companies, chain agnostic, who you would think would be perfectly happy supporting any chain. They just need that chain they need a chain, right, to have to create that network effect so that their applications are available to as many people as possible. Analogous to if you're a developer, if you're a developer of mobile games right now, you don't really care that whether it's iOS or Android that is the dominant operating system. You just need a lot of smartphones in people's hands, and because that's your route to market. So I think that it really depends on how the portfolio on the application side is constructed.
And then on the scaling side of Ethereum, I think the big news right now is Ethereum 2.0 and the staking involved in there. So there's two questions I would have with regards to the futures market specifically. In terms of first settlement, I think that with CME it's cash settled, so I don't think that there's an issue there. For physically settled Ethereum futures, has it been discussed as to which chain it would settle on, or do we just not have physically settled Ethereum futures trading just yet?
So for the CME, it's a cash settled product, so it settles to the index provided by CF Benchmarks, so that's not a concern. I'm not aware of any physically settled futures yet, but certainly that you raise a great point. Whereby, if people are thinking about physically settled futures, then they are going to need to really understand the different pools, as you mentioned, and the status of the various ethers out there, whether their fungibility, etc., etc. As you know, Pierre, as part of CF Benchmark's work, we actually calculate free floats of cryptocurrencies. So not only what's been issued, what exists, but what can actually be spent at any given moment in time. So it's not locked up. It's not engaged in, say, a smart contract that has a term, which means it can't really move. And so, we've been tracking the development of the ETH 2.0 staking pool very closely. We see that about approaching 2.5% of all the ether that can be spent is now in the ETH 2.0 pool, and one assumes that will only grow. So that will have an impact on the free float supply out there. And as you say, if there is a physically settled futures market, it affects how much ether you can get hold of to deliver to fulfill your side of the contract. So if anyone out there is designing a physically settled future, I'd say good luck, and do feel free to contact CF Benchmarks if you need any free float data.
And my second question on the staking is that we see in the futures market, participants will, for example, buy Bitcoin on the spot market and then sell a futures contract at a higher price than the spot price. And so they'll earn an implied interest rate from that transaction. Do you think that staking is for chains that do have a yield or rewards that are generated by staking, that there's competition between the futures market and the protocol rewards?
Effectively, yes. I mean, whether an interest rate is codified or implied, the net effect is the same. You end up with more. So certainly, that it creates an interesting dynamic. It will create an interesting dynamic, and I think that as an index compiler, as a data guy, for me, the interesting part will be whether those two, whether that implied interest rate and the actual interest rate, if you will, if they will converge, diverge, how they will behave relative to each other, because obviously, if there is obviously opportunity for someone who calculates consensus views of metrics to insert themselves into that sort of situation, and it's something that we're actively looking at.
Great. Well, Sui, thanks for joining us today on Kraken Livestream. We got through some very technical topics, but I think that our audience really appreciates learning about all the different parts of the crypto market and how CF Benchmarks is creating value for folks and having a very reliable, robust price mechanism or price feed. Is there anything you wanted to announce? I know that you have been working on a tax calendar. Would you like to describe what that calendar is and how folks could use it?
Yes, of course, Pierre. So thanks for that. It's always great to be on, and we're always busy trying to get the most out of our indices, to get the most for cryptocurrency investors out there. And one of the things we did towards the end of last year was to publish a tax and reporting calendar, which gives the index price, our official index price for a bunch of cryptocurrencies at key dates. And we've updated this with the all-important midnight on December the 31st price for 10 cryptos, to hopefully help all the hodlers and investors out there and traders out there who need to file tax returns, who need to report for audits, need to file accounts, etc., so that they've got a price that they can use to file and answer any questions they might get from anyone by referring them to the CF Benchmarks website. So hopefully that helps in a little way alleviate some of the frictions that come from investing in cryptocurrencies.
Perfect. Well, thank you for publishing that. With my own background in financial accounting, I know that it can be hard to get a good rate and to have a defensible rate that will stand up to scrutiny. So thank you again for joining us today, and looking forward to talking again as 2021 unfolds.
Wonderful. Thank you very much again, Pierre. Speak soon.